we're tracking another report released by the World Bank. India's GDP growth, World Bank says, is likely to moderate to 6.3% in financial year 24 due to shrinkage in consumption on the back of slower income. The World Bank has lowered its forecast for India's economic growth in the current fiscal year from 6.6 to 6.4. World Bank and 6.3. World Bank, in its flagship report, India Development Update Spring 2023, said that rising borrowing cost and slower income growth will weigh in on private consumption. So private consumption there could prove to be a dampener. World Bank projects retail inflation in India to be at around moderate of 6.6 to 5.2% in financial year 24, so which is well within the RBI's tolerance limit. From 6.6 at the moment, inflation could come down to 5.2% in financial year 24. India's current account deficit, CAD, the difference between exports and imports, is also expected to be at 2.1% in the financial year 24. With me, my colleague continues to be here. Shubhamoy is also with us. Karthik, coming to you first. Not a lot of difference there. 0.3% growth forecast lowered for India's, GDP growth. Not a substantial cut down, but something that could affect us in the long run.
I think, the cut down, I believe, has largely come on account of, again, the revision in the fuel prices, which is likely to happen as a result of OPEC Plus cutting down production and rising fuel prices that Shubhamoy was just talking about. What surprises me is the fact that that the World Bank says that the slowdown will happen on account of lowered consumption, and that lowered consumption is on account of lower incomes. So I think largely the problem that we are talking about is employment stroke unemployment. Employment being the opportunity, unemployment being the advantage here. But I think largely the fallacy that I see in this system is consumption likely to slow down. And data, for some reason, doesn't correlate that very well, because I was just going through FADA numbers also, which got released today. Incidentally, Mahavir Jayanti, great day for a lot of reports to be released on a day bereft of news. But FADA numbers have just come in for the month of March, and Y on Y, we are seeing passenger vehicle sales are up 14%, two-wheeler sales are up 12%, commercial vehicle sales are up 10%. So overall, we are seeing that that there is consumption. And just a day or two ago, we had done another story on auto and housing being the real growth drivers for India. Now, apart from these high value purchases, what is left is technically essentials. And I doubt even in an inflationary environment, there is going to be a lot of cut down on essentials or on household items, right, which become a must have rather than a could have or may have. So I wonder what really, is leading to this slowdown in consumption that the World Bank is talking about.
Okay, let's bring Shubhamoy in. Maybe he can fill us in on what exactly is the expectation. Where is consumption missing? Just to reiterate with what Karthik said, there is consumption in the auto space. We tracked the story closely day before yesterday. There is also growing consumption in electronics. There is growing consumption in various other allied sectors. So what exactly is hurting consumption? Is it the pent-up demand? How are you seeing it going forward, Shubhamoy?
Well, what Karthik is saying is right. It's been too far down the COVID line to sort of say that this is just entirely pent-up demand. I do see the fact that consumption is returning to the market. If you look at even further number of figures at the top end, if you look at flights or the number of passengers at the airports, those numbers have almost come close to the 2019-20 numbers, almost 97 or 96%. At the lower end, if you look at the microcredit, when I was looking at them closely, I find that those numbers are actually holding up surprisingly, and actually the credit there has increased, and the default rate there has actually come down very substantially. So definitely, there is very little to suggest that the consumption is hurting. Also, my sense of what the World Bank data is that, first of all, as you would have seen, unlike the pre-COVID periods, because of the fluctuations that's happened in most economies across the world, forecast agencies are essentially going in for what is called quarterly revision. The World Bank does it twice a year, but those twice revisions are essentially based on internal 3-monthly revisions. most GDP projections by any agencies are therefore good only, according to me, only as a quarterly projection. I would not look at them as something which is a trend for the entire year. They are subject to huge fluctuations, and that will happen. And we shall see more as the data goes along, more numbers coming up later in the year, which will be more accurate. About the only thing that I take it on is that, yes, as everybody has more or less been saying, that FY24 will be slightly be tougher than FY23, but for various reasons. And one of the things that will be happening is that the export market is essentially hurting a bit. And when I say export market, I largely mean the export of goods. Because of no fault of India, the fact that the global economy is not really at a best of health, exports are hurting. To the extent that exports hurt, that has a backward linkage into the rest of the economy. And to that extent, the economy gets affected in terms of its production process, in terms of throwback of consumption into those who are working on the export sector, on their income levels, and so on. So that's where the weakness is there in the economy substantially. The other thing I would actually say to reverse it will be the fact that this is the year when there's an election happening, general elections happening in May 24. And before that, we have series of state level elections. In the Indian spending cycle, election years are years when actually consumption rises because more money comes into the economy. I have not seen so far any of the forecast agencies taking this into account, but if they look at consumption behavior of the Indian economy in election years, they would notice that the very fact of the election process tends to raise consumption. So that has to be factored in, and that could actually make the forecasting agencies feel a bit surprised in terms of the actual numbers when it comes later on. But at this stage, that's where I'll stop.
Right. So, Shubhamay, talk us through the cost of capital in this case, because we've seen, of course, inflation. We've seen the rate hikes to tame inflation. Inflation steam still continues to be sticky. And add to this, of course, companies now picking up capital from banks at a higher interest rate, at some level passing that cost on, which will have a further impact on pricing, on inflation. In this context, do you see demand getting at some level maybe subdued because of the sticky inflation and a higher cost of capital, cost of borrowing?
Well, obviously, when the cost of capital rises, to some extent, that does affect capital expenditure. But I was looking at, say, okay, let's take a sample bank like an HDFC bank.
Yeah.
I was looking at their credit offtake. Now, that credit offtake number tells me that that after a period of being rather flat, credit offtake has actually begun to rise. And why is that so? Because credit decisions, and I'm talking about long-term credit decisions, these are rising now because they would be the result of both decisions taken about a quarter or more ahead.
Correct.
So, no company would be taking decisions to expand their production capacity based on the cost of money now. They would have been taking it for a couple of, at least about 1.5 quarters ahead previous.
Right.
So the impact, if you say what will be the impact of the current cost of capital, that we will see down the line. Right now, what we are seeing is the credit expansion happening and would be happening more substantially because of the price of capital, which it was, say, about a quarter and a half ago, when it was lower. And based on that, companies are basically sure that they will be needing to expand their capacity. The RBI Obicus survey, which essentially looks at what is the capacity that companies are looking at down the line, shows expansionary trend finally taking off substantially. Which means that the economy now, you would find more and more companies talking about expanding their production capacity. That is going to take place just as the effect of the latest round of capital cost increase is going to take place further down the line.
Right.
So we should not be conflating the current cost of capital with what is happening right now in terms of the capital expansion. The capital expansion has already started happening, and
Right.
it's happening with the project with when the costs of capital was somewhat lower. So my sense is that this beneficial effect is going to happen over the better part of 23 calendar year.
Right.
In 24 calendar year, we shall be seeing the softening effect, but that will come later.
Right.
Right now, therefore, I am not going to be looking at sort of a squeeze, but rather an expansion of credit. Also, the interesting thing to look at is if you look at the cost of capital, the cost of working capital and the cost of long-term capital, the differential between them has narrowed substantially,
Right.
which means that companies are able to take a punt on investments in machines and plants much
Right.
more easily than expanding their immediate production. So
Absolutely. And that will
there
have a
is a
multiplier
very
impact. And that's sure to have a multiplier impact, of course, on on their overall operations going forward. But talk us through the inflation target, 5.2. World Bank's calculation, 5.2 versus 6.6 looks achievable.
yes, this is more or less fair because if you are talking about initially when the cost of capital rose, what was RBI doing? RBI was essentially saying that the amount of goods and services in the economy hasn't expanded. There's been a COVID shock. So if there's too much money in the economy chasing the same amount of goods and services, obviously there'll be higher inflation. So
Right.
RBI has consistently raised the cost of capital. Now, because of doing so, why even as RBI has done it, it has sort of raced up behind the rise in money expansion. And the result of that you've seen in terms of the inflation going up
Right.
beyond 6%. And even the core inflation has gone up to above 6%.
Right.
What is the impact now? We just talked in the last question that we were discussing about the fact that production is now expanding. When production is expanding, the money that is there, RBI has stamped down on the supply of money. It asked money to be squeezed. So what's happening is that there is now a larger supply of production available of both goods and services, with the promise of even larger ones coming through, whereas the supply of money is not rising at that same pace.
Right.
So obviously, it stands to reason that the inflationary pressure in the economy has gone past its peak and it has started going down. Now, whether it'll be 5.2 or whether it'll be 5.1 or whether it'll be 5.4 is something that will be depending on seasonal factors. For instance, right now, we are going through an unseasonal burst of rains that will have its effect on agricultural production. So that could actually lead to rising in the price of cereals. At the same time, it might actually lead to an improvement in people's purchases of many of other needs of daily things that they would want daily, because they might want to actually go out and spend. So there are lots of stuff that comes along to adjust that weaken the exact inflation figures. But there's no doubt about the fact that the inflation has peaked and is going to come down as I said, the production has risen and the supply of money is not rising as fast as it was earlier. Yes.
Before I let you go, Shubhamayana, we're hoping to get you back shortly, but RBI's MPC is underway. What are your expectations with respect to rate hike? We know we are expecting, of course, a rate hike, but what are your large, broad expectations there?
Well, last time, as you saw, the vote was divided. And that essentially means that the MPC is not very clear, which is fair enough because the data that they're looking at is not giving a very consistently one-sided view. Couple of cycles earlier, it was very clear that the money supply was still racing ahead. Now, because of the factors that we're talking about, the inflationary peak has come. It's a question of tamping down on whether the inflation has gone past the peak. According to me, it has gone down. So to that extent, the RBI might decide to hold its horses for the time being, and because that because as you can see that our US Fed is also talking about raising rates, but not at the aggressive way as it was doing earlier.
Right.
So the need to maintain a differential between the US market and the Indian market, which is also a very significant factor which affects the RBI's decision, is also softening up. So I would tend to think that RBI will possibly be veering towards a holding position right now, saying that this period of inflationary spiral has essentially come to an end.